Welcome to our channel, everybody. You know, so many people tell me they're afraid to invest. They're scared of making a mistake. Well, I say, knowledge is power, and today, we're going to empower you to take control of your financial future. We're diving into the top 10 ETFs to buy in the US stock market. If you're new to investing and feel anxious about money, this video is for you. We're going to break down this whole ETF thing in a way that's easy to understand. You're going to learn what you need to know to get started, and I promise it's easier than you think. So, let's get started and turn that anxiety into confidence. Are you ready to become a powerful investor? I know you are. Let's do this. Before we get to the list, let's talk about what an ETF actually is. ETF stands for Exchange Traded Fund, and it's like a basket of stocks. Think of it as a pre-selected portfolio of companies. Why are ETFs great for beginners? They're diversified. ETFs spread your money across different companies. They're easy to buy and sell, and they're cost-effective. ETFs are a fantastic way to start investing. First up, we have the Vanguard S&P 500 ETF, also known as VOO. This ETF tracks the S&P 500 index, the VIP list of the US stock market. We're talking about 500 of the biggest companies like Apple and Amazon. Investing in VOO means owning a piece of all these companies. It's like having a front row seat to the American economy's growth. Over the long term, the stock market tends to go up. Historically, the S&P 500 has delivered solid returns. VOO is a great place to start investing in the overall market. So we've tackled the US market, but what about the rest of the world? That's where IEFA comes in. The iShares Core MSCI EAFE ETF gives you exposure to international stocks from developed markets outside of the US and Canada. We're talking about countries like Japan, the UK, Germany. Investing globally helps diversify your portfolio. Different regions have different economic cycles. By investing globally, you're spreading your risk and potentially increasing your returns. Number 4. Schwab US Broad Market ETF, SCHB, covering all your bases. Next up, we have the Schwab US Broad Market ETF, or SCHB for short. This ETF is like the ultimate all-in-one package for the US market. It covers the entire US stock market, including small, mid, and large cap stocks. Now, you might be wondering, Suze, what's the difference between SCHB and VOO? They both seem to cover the US market. You're right, they both invest in US companies, but SCHB casts a wider net. VOO focuses on the 500 largest companies, while SCHB includes those big players plus thousands of smaller companies. This means you're getting even broader exposure to the US economy, which can be a good thing if you're looking for potentially higher growth. Number 5. SPDR Gold Shares, GLD, your safety net in uncertain times. Let's talk about gold for a second. Gold has been a store of value for centuries. It's what's known as a safe haven asset. When the market gets shaky, people tend to flock to gold because it's seen as a reliable way to preserve wealth. Now, I'm not saying you should put all your money in gold, but having a small allocation to gold in your portfolio can be a smart move, especially during times of economic uncertainty. And that's where the SPDR Gold Shares ETF, or GLD, comes in. GLD allows you to invest in physical gold without having to worry about storing it yourself. It's a convenient and cost-effective way to add some shine to your portfolio. Number 6. Invesco QQQ Trust, QQQ, riding the tech wave. Now, let's talk tech. The Invesco QQQ Trust, or QQQ, tracks the Nasdaq 100 index, which is home to 100 of the largest non-financial companies listed on the Nasdaq stock market. And guess what many of those companies are? You got it. Tech giants. We're talking about companies like Apple, Microsoft, Amazon, Facebook, and Google. These are the companies that are shaping the future, and with QQQ, you can invest in their continued success. Now, I know what you might be thinking. Isn't tech risky, Suze? And you know what? It can be. But it can also be incredibly rewarding. And QQQ lets you spread that risk across 100 of the most innovative companies in the world. Number 7. iShares Core US Aggregate Bond ETF, AGG, the importance of bonds. Now, let's shift gears and talk about bonds. Bonds are like the responsible older sibling of stocks. They're not as flashy, but they play a crucial role in a well-balanced portfolio. The iShares Core US Aggregate Bond ETF, or AGG, provides exposure to the total US investment-grade bond market. Think of it as a diversified basket of bonds from the US government, corporations, and other issuers. Bonds are considered less risky than stocks, and they can provide a steady stream of income. They also tend to move in the opposite direction of stocks, which means they can help cushion your portfolio during market downturns. Number 8. Vanguard Total Stock Market ETF, VTI, your all-access pass to the US market. Remember when we talked about VOO and how it gives you exposure to the S&P 500? Well, the Vanguard Total Stock Market ETF, or VTI, takes it a step further. VTI gives you exposure to the entire US stock market. Large cap, mid cap, small cap, the whole shebang. It's like having a key to the entire stock market kingdom. So, if you're looking for the most comprehensive coverage of the US market, VTI is your go-to ETF. It's a great way to ensure you're not missing out on any potential growth opportunities. Number 9. iShares Russell 2000 ETF, IWM, investing in small giants. Now, let's talk about the little guys, small cap stocks. Small cap stocks are like the startups of the stock market. They're smaller companies with the potential for big growth. The iShares Russell 2000 ETF, or IWM, tracks the Russell 2000 index, which is made up of 2,000 small-cap US companies. These are the companies that are often overlooked by the big investors, but they can offer some of the most exciting growth potential. Now, I'll be honest, small-cap stocks can be more volatile than their larger counterparts, but they also have the potential to deliver outsized returns. So, if you're comfortable with a little more risk, IWM can be a great addition to your portfolio. Number 10. Vanguard Dividend Appreciation ETF, VICI. The power of dividends. Finally, let's talk about dividends. Dividends are like getting paid to own a stock. They're a portion of a company's profits that are distributed to shareholders, usually on a quarterly basis. The Vanguard Dividend Appreciation ETF, or VIG, focuses on companies that have a long history of increasing their dividends. We're talking about companies that are financially stable and committed to rewarding their shareholders. Now, dividend-paying stocks might not be as exciting as some of the high-growth tech stocks we talked about earlier, but they can provide a steady stream of income, which can be especially helpful during retirement. Outro. Start. Investing in your future. Today. There you have it, everybody. Our top 10 ETFs to buy now. Remember, investing doesn't have to be scary. With ETFs, you can start building a diversified portfolio that aligns with your financial goals. If you found this video helpful, please hit that subscribe button and give it a thumbs up. And don't forget to share it with your friends and family. Let's spread the financial knowledge. Remember, the most important step is to just get started. The sooner you begin investing, the sooner you can start working towards financial freedom. I'll see you in the next video.